Hi, this is Larry Lane from InvestorZoo.com and just wanted to touch on bonds and some fixed income instruments that may give you a little bit higher rate of return than your current checking account at your bank. You can purchase a CD from your FDIC insured bank. Generally, they'll pay a little bit higher interest than your checking account. You can purchase CDs in 3, 6, 12 months. You can go out to 5 years or more on CDs. You get an interest rate payment every 3 months, and then your full principal back at the end of the term of the CD. You can opt to go with a U.S. Treasury bond or U.S. Treasury note. These are considered the gold standard. Obviously, they're backed up by the full faith and trust of the U.S. government. However, you are going to be tying your money up for a number of years to get any type of decent return. Current rate of return on a 10-year government bond is around 3.25, 3.5%. TIPS are another interesting bond put out by the government. TIPS are considered Treasury inflation protected securities, and your rate of return will be backed by the CPI. So your interest rates will rise and fall with that CPI number. Muni bonds or municipal bonds are bonds that are issued by municipalities and individual states. Muni bonds are federal tax-free as well as state tax-free if you purchase the bonds in which the state that you live. Muni bonds generally pay a higher rate of return than U.S. government bonds. While it's hard to imagine a state or municipality defaulting, anything is possible. Corporate bonds are another great way to increase your yield. Corporations will sell bonds to expand their business. Bonds are rated by agencies such as AM Best and Standard & Poor's. The higher the rating of an individual company, the lower the interest rate will be. So in other words, you'll be getting a lower rate of return on an IBM bond and a higher rate of return on a bond issued by a small or a mid-cap company that has a higher rate of default. To diversify your bond holdings, you might want to consider purchasing a bond fund or a bond ETF. There are dozens of different offerings out there. Just check Morningstar or put on your favorite search engine under bond funds. You'll find dozens upon dozens of funds to go with. During the course of holding your bond, it's a common misconception that you can't lose money by buying bonds. If you do have to sell them early, you can lose money. Reason being is that interest rates can fluctuate both up and down. So just in round numbers, if your current bond is paying 5%, a year or two goes by and inflation spikes up to 7 or 8%, the bond that you bought is going to be worth less because no one's going to pay you the same amount of money to buy a bond paying 5% when they can just do the same thing and purchase a bond paying 7 or 8% or more. So the only way you can't lose money by buying bonds is if you buy a bond and then hold on to it till its full maturity rate. So always check with a financial advisor before making any single investment. Make sure that you do your due diligence. This is Larry Lane for Investor Zoo. Have a great day.